Mantesh, good afternoon. Thank you for joining us. Mantesh, do you agree with my assessment or would you like to come up with a different view?
Broadly, what you've outlined is quite right, but I do not belong to the camp that says that the delisting price will be somewhere in that 175, 190 rupee mark that you outlined. I think it is very clear, even from the current book that has been built, that most of the median price at which the shares have been tendered is somewhere around 138 rupees, which was the price until yesterday. Today, of course, the stock has collapsed. So what we're going to see potentially going forward is that this company, Vedanta, will continue to receive what is called as a discount, a promoter-led discount to its share price. So a lot of people say that it is trading below book value and so on and so forth. There is a reason why it is trading below the book value is because there is a promoter-led discount which is being offered to the stock, and that is what in a way we are seeing right now. So the fact number one, which I've already pointed out, is that the median price at which the bids have been coming in are at 138, which was the price virtually as of yesterday. That's number one. Number two, it is unlikely that the management will accept this price because at 138 they'll have to shell out close to 20,000 crores, 19,000 plus in terms of amount, whereas the floor price is 87 rupees, and at 87 rupees the amount required is far too less, just about 12,000 crore, 11,000 crore. So the point here is that from what we are seeing right now between the stock price in the market versus the bids that are getting received, it appears that the delisting may fail.
Okay, so Mantesh, now there are two types of investors or positional buyers here. One, those who bought in anticipation of a quick buck, which is that let's say a month ago the price was 110, 120. A lot of HNI investors and positional traders have bought in anticipation that the delisting will happen north of 150, 160 and they will get a clean exit. Second are long-term investors who have to ask a question that should they tender the stock at the current price. I mean 130, 135, that's a variable call, but should they in principle tender the price? So what would we advise to the two classifications, those who bought for a delisting pop and for those who have been holding on to Vedanta for the long haul? Should they surrender or tender the shares?
Those who are holding the shares for long term, please understand that they would be sitting under a loss right now, given by the current shown by the current market price, because the stock has been coming down like for a couple of years. It's not for given any return to really the long term investors. So there's no point holding this stock further more or for a longer duration because there are other better stocks available even within the same space. So for long-term investors, clearly, irrespective of whether the delisting existed or offer came in or otherwise, it was time to switch over to some better stock. As far as the persons or the investors who have bought in anticipation of a quick gain because they assume that the delisting price or the exit price will be much higher, will probably not get that price simply because the offer may fail, like I outlined earlier, given the pricing environment right now around the stock and the bids that have been received. So I would guess that post this offer, what will really happen is the general interest levels in the stock will be very limited, and therefore it will be natural that the stock should fall.
Yeah, exactly. The delisting attempt by promoters may actually fail is the going concern in the market because some reports are suggesting that the discovered price may be at about 4 to 5 times of the indicative price. And that's why you're seeing such a sharp sink coming in on the stock. 8.5% lower and still counting lower as we speak, although it was worse off just a short while back, has recovered just somewhat from those levels. The breadth of the market continues to be weak. Bajaj Finance, that's down 4.25% as we speak. And Mantesh, clearly seems like the markets were anticipating a much faster recovery as opposed to what the Q2 report or update of Bajaj Finance has actually indicated.
So I don't want to really look at per se Bajaj Finance. Let me just touch upon the fact that the NBFC sector as a whole is going through stress. Unlike the banking sector, which is well supported through RBI's forbearance and some degree of government support coming in, NBFCs have to sort of swim in this tide, against the tide, and come out with better numbers. And really, in the current pandemic situation, the tide is against them. So in such a situation, I would reckon that most of the NBFCs will have to do a lot of things first, but raise enough capital, see to it there is enough liquidity, improve the collection efficiencies, be very careful in terms of their lending activities. So to sum it up, it seems that the future outlook, therefore, for most of the NBFCs, at least for the next 6 months to 7 months, by which time the COVID recovery will be past the COVID stage and will be in a recovery mode. So these 6 months will be difficult times for most of the NBFCs, and it will be like swimming against the tide. There are a few good companies, Bajaj Finance being the largest one of them, of course, carries a natural advantage of size. So it's better to stick to size when it comes to NBFCs. But otherwise, as a sector, they will be in for difficult times as we go ahead.
Sure. Okay, that's Bajaj Finance and Trade for You. Pretty much has been at the lows of the day and staying put at that downtick of 4% as we speak. And that weakness is rubbing off on some of the other NBFCs as well in today's trading session. But let's move on. Let's talk about Reliance Retail getting a fresh check this time around from ADIA. Almost 8.5% of the equity has been divested in RRVL. Let's take it across to Ajay, find out more about this investment.
Well, that's correct. The checks just keep on flowing, and this time it's Abu Dhabi Investment Authority which has actually planned to put around 5,500 crore in Reliance Retail. Now, this actually joins the checks of Mubadala, TPG, Silver Lake, so many of them. If you look at it, KKR, General Atlantic, all of them have actually come in, and all of this has happened in the matter of 4 weeks. The valuation for this one is also happening at 4.28 lakh crore thereabout, because that's what's the valuation picture is emerging at. Almost 38,000 crore have come in last 4 weeks alone in Reliance Retail. Now, retail is actually cementing its position because of the technology backbone. 640 million footfalls coming in, and now after this acquisition which they recently did of the Future Group, we're talking about 12,000 stores across the country. So they are becoming a unique omni-channel model of brick and mortar as well as an online. Online, of course, kicked off big time during this pandemic, and brick and mortar retail got hit. But electronics, grocery, etc., clearly flying off the shelf even during the pandemic because of JioMart, etc. So it's a unique integrated retail play which these institutional funds are very interested. It is scalable. In fact, if you read some of the recent brokerage reports, which are assigning anywhere between 650 to 700 rupees a share as far as sum of part valuation is concerned for Reliance Retail, talks about big numbers in the next 3-4 years, and probably that is what is bringing such high quality marquee investors. So it's good news for shareholders. It will be interesting to see how stock reacts in trade. Last couple of days, perhaps bulk of the positive news is already getting built in, and the way Reliance Jio platform investments, the street used to react, the same kind of intensity in stock reaction is not being observed. But clearly, fundamentally, it's very good, and the checks keep on flowing. So good news for shareholders.
Thanks, Ajay. Now, TCS kickstarting earnings season tomorrow, and lots of expectations, of course, on operational performance after the Q1 lockdown. But we're also waiting for commentary on buyback plans. So Poonam has more on that for us. Poonam?
Well, TCS is going to kickstart the Q2 earnings season, and in fact, after revenue degrowth in the last quarter, expect revenues to grow by nearly around 3.2% in constant currency terms on a quarter-on-quarter basis. Dollar revenue is seen at 5,300 million, which is up nearly around 5% quarter-on-quarter. Cross currency benefit is seen at nearly around 185 bips. In fact, EBIT margin is expected to expand during this quarter. Margin expansion of nearly around 160 bips is seen with a margin of 25.2%, and this is going to be led by strong volume growth, cost control, as well as efficient execution. In fact, analysts do expect the deal wins also to be fairly healthy during the quarter at $6.4 billion, according to few of the analyst estimates. This is versus a nearly around $6.9 billion in Q1. In fact, management commentary in terms of outlook and guidance would be very, very important. In the last quarter, management stated that the COVID impact had bottomed out and they should now be tracing the path to growth, and they also stated that they expect the revenue to be flat in constant currency terms by Q4. Hence, commentary in terms of guidance, outlook on revenue would be fairly important, along with the update on buyback as well as the capital allocation policy. Besides that, of course, comments in terms of the deal wins, deal closure, pricing, and growth in digital services, demand trends across the verticals would be fairly important. The stock is already trading at premium valuations after it recently hit record highs.
Okay. Mahantesh, from the mid-caps, whole host of them, Berger, Loris, we can go on with the list, that are also trading right now at their 52-week highs, continuing to look incredibly strong when it comes to the, price performance. Anything that's catching your eye where you feel the trend is sustainable?
I think particularly two sectors within the mid-cap space are looking interesting, and that's born out of what we have generally seen happen with the economic recovery process. So number one, it has got to do with the agricultural sector. So agrochemicals is doing really well. There are a lot of companies out here, from MNC companies to local homegrown kind of agrochemical companies to large corporate houses also working in this space. So the agrochemical space is something which looks very attractive in the near term to medium term. That's one space that I would pick in the mid-cap sector. And in terms of the recovery process, we've been positively surprised by how automobile sale numbers have been coming up on a monthly basis, are getting reported on a monthly basis. We have seen decent growth even on a year-on-year basis, irrespective of whether it is pent-up demand or otherwise, in the automobile sale numbers of, say, Maruti to Hero MotoCorp. That's September over September of last year. So these numbers tell us that the production activity would have been ramped up at the OEM levels, and therefore some of the auto ancillaries would likely benefit from this process. So agrochemical space on auto ancillaries are the sectors that I would pick up within the mid-cap space. And we also have this SEBI circular on the multi-cap scheme giving sufficient tailwinds for some of these stocks to really do well.
The star for me, frankly, is Thyrocare. Between yesterday and today, a stock which was at 800 now is at 1000. Where is it right now? 1000 plus actually. Mahantesh, Thyrocare, first it was Metropolis I think on Monday, and then Thyrocare yesterday. Metropolis has said that the business volume is at a record high, and Thyrocare also seems to be suggesting the same, and is also sharing that the COVID business has added an extra vertical to their revenue line. How would you value the diagnostic space and then Thyrocare specifically?
Nikunj, if you go back into March when the phenomenon on the COVID was gathering pace, even we, along with the other market participants, were advocating that these diagnostic companies, medical diagnostic kind of companies, would really do well. So you named Thyrocare as one of them, Metropolis is another one. including hospitals also. So we were quite gung-ho about it, and we had picked up Metropolis as one of our stock picks in the quality stocks that we had identified way back in March. It has done well so far after the dip in between. But going forward, the uptick in business is not a surprise for many of these companies. Remember, because of the lockdown, a lot of people didn't really venture out to get their various kinds of regular tests done. So now you're finding that rush to get yourself tested. A lot of people carry diseases, lifestyle diseases, which require frequent testing and so on and so forth. So therefore, I reckon that these companies are seeing a rush in demand because of some kind of pent-up activity demand here. I don't see that sustainable going forward. As it is, given the stock price run up that we have seen, it is really time to get out of some of these stocks. The valuations are too high. They are building in too high a growth even for succeeding quarters. And quite frankly, I don't see that happening in terms of growth.
Mahendesh, I have a very quick follow-up question on diagnostics. Okay, let's work with the assumption that the COVID testing is here, and the COVID testing is something which nobody expected. So it's more like a business which had broken down, has got normalized now that lockdown is over, and COVID is that extra cherry on the pie. But the whole science behind COVID testing, Mahesh, we understand, is that these tests would be dramatically cheaper, and they actually could be very disruptive in terms of pricing as well. We understand that just like you have diabetes and a pregnancy test kit, a COVID test kit is also coming. So somewhere those who are buying the stock with the assumption that the diagnostic business will be benefiting because of a permanent upside from COVID, are they in for some disappointment? Have the stocks run up slightly ahead of themselves?
Yeah, I think you have hit the nail. This is exactly what I was trying to explain and say that this is the right time to sell these stocks, because the growth getting factored in the valuations assume this permanency of the demand surge that they are seeing in terms of testing. And you rightly pointed out there will be disruption in the pricing of elements of some of this testing, and which will mean that from a margin perspective, there will be margin destructive business expansions for many of these companies, and therefore we no longer hold a positive view on these set of companies. The run up in the stock is a welcome move for many investors to actually book their profits and take the profits home.
Sure. Just want to quickly bring up what Titan as well has been doing, considering this is the big buzzer today. About a 5% uptick is what you're seeing on the stock. The street has, of course, liked the Q2 update on that the management actually gave out as a commentary. I'm going to, in fact, take it across to Vinny as well and get in more updates on what the Q2 update is like.
Titan came out with its Q2 FY21 update, and the company is talking about returning to normalcy and how the process is going on. They did say it's going on quite well, and they are slowly recovering to normalcy and coming back to normalcy. The process is on. Now, overall, they spoke about the consumer sentiment. They said that, consumers seem to be accepting what is the new normal, and, that they are seeing increased footfalls overall in the malls as well, in the stores as well. Though in malls, the footfall is relatively lower compared to in the stores, but surely some signs of improvement and recovery compared to last quarter. So some positive sign coming in here for the company. Now, overall, let's talk about the jewelry segment, which is a very important segment and accounts to most of their revenues. That saw a recovery of 98% in Q2, and this recovery is excluding the raw gold sales. So overall, walk-ins have improved, and conversion with improving conversion rates. Overall recovery in the metros also has been improving gradually, which was impacted the most, while non-metro cities have improved substantially, is what the companies have said. Studded ratio is yet to recover to the previous levels, and so we could expect the studded ratio still to be lower compared to previous quarters and previous levels. while wedding jewelry has done particularly well for the company in Q2. Overall, the company has continued to sell the excess gold inventory they had, and this quarter that they have sold around 390 crores of this excess gold inventory. Now moving on to the watches segment, that has recovered 55% during Q2. E-commerce channel has been leading the growth for the company, while trade channels are still posing certain challenges due to destocking, and work from home culture also is something that has impacted the company, and overall, the LFS large format channels have not done quite well for the company. Eyewear segment again has recovered 58% in Q2, and in the month of September both watches and eyewear segment have recovered as much as around 70%. So that is something we're going to watch out for, and all in all a better set of numbers compared to Q1.
We chatted with the Tanishq management in specific. Let's hear out what they have to say about jewelry demand as we step into the festive season.
It's been really an encouraging response to see numbers and to see consumers come back into stores month on month. There has certainly been a positivity and an impact on sentiment thanks to a lot of festivals that we have seen in the last couple of months from August onwards, whether it was Raksha Bandhan or Ganesh Chaturthi or Eid or Onam. It's been, all of them have added to positivity and a certain improvement and uptick in consumer sentiment. And therefore, we believe that as we head into Dussehra and Diwali, this sentiment should only improve. Yeah, like I mentioned, there was a period of about 10 days in August when there was a surge as people felt that gold rates will continue to keep surging. But since gold rates since then have cooled down, I think we don't see a significant surge in demand led by gold rates.
Mahantesh, let's get your view in Titan, and today a 5% move coming in there on the counter.
So I would again come back to the same theme that there is a lot of pent-up demand that is coming up, and particularly on the wedding side, we were also looking at matrimony.com, not a stock that I want to recommend, but the kind of commentary that they've been giving suggests that there would be a bunch of so-called marriages that will happen towards the later part of this calendar year and early part of next calendar year. So that bunched up the marriage demand-led gold buying activity or jewelry buying activity will remain at an elevated levels, and therefore Titan as a company would stand to gain. There's also another phenomenon that is happening is that we have had good monsoons so far. We will have possibly another record food grain output coming in, and because of which the rural economy has been doing quite well, and that brushes off in terms of demand for gold and silver kind of jewelry, generally consumer durables to even gold. So with this underlying current that we are forcing in the economy, I wouldn't be surprised if Titan keeps doing better and better as we go ahead.
All right, Kunal, we'll leave it there. Thanks so much for joining us. We're going to take a quick break. We'll come back and continue this conversation on the other side.
What a great day of trade for Titan. It's a Nifty 50 stock, 5% higher for Titan. You got Bandhan Bank, which is up by 2%, and then it's a day which really belongs to two-wheelers. 52-week high for Hero MotoCorp and 52-week high, almost 52-week high for Bajaj Auto. Mantesh, autos are selling, economy is recovering, car buyers are back, HFC demand is picking up, but nobody is interested in buying banking stocks. My simple question is that if auto sales has picked up and if people are buying two-wheelers, then obviously the credit flow has picked up somewhere and the lending activity has started. How come nobody is talking about buying banks or NBFCs which have a dominant portfolio of two-wheelers or vehicle finance or towards four-wheelers?
No, you're right that it's a question that even kind of haunts us. But then you remember that over the past few years, we had seen the aggressiveness of some of the NBFCs taking away market share from the banks, in particularly the personal lending space, and that probably is could be possibly one of the reason. But that's perhaps the very small percent of the reason right now. What most people are worried about is that the banks also have a wholesome book. It's not just personal loans, and within personal loan, it's not only auto loans or we're not talking about just housing loans. There are corporate loans as well. There are a large chunk of SME loans that they are exposed to. So in this process, what happens is that when one portion of your book starts deteriorating faster, you naturally will have to build in capital buffers. If you don't have capital buffer as a good bank, you'll have to start building one. And I think investors are conscious of this fact that between the deterioration in the book and the capital buffer that is getting built up, existing investors are getting short-changed because there is dilution of the book. At the same time, there is no accretion to the book coming in from normal operations. So I reckon this is the simplest reason why banks are not really doing well at this juncture. But then, if you take a forward-looking kind of view, then obviously banks should be doing better as the economy recovers. So I think it's only time that banks start rising with the tide.
If you have to choose one two-wheeler stock, and there are three stocks which have three different propositions, the similarity here is that we like to call them two-wheelers. Hero MotoCorp, India's biggest, complete play on domestic. Bajaj Auto, play on domestic as well as exports recovery, and Eicher Motor, which is a complete play on urban recovery. Which of the three two-wheeler stocks would you vote for? Why? And a one line on it.
Eicher is looking far better among the three, simply because there is, it's not just about the urban phenomenon. I think an element of competition that they were facing is slowly abating, and there is an opportunity for them actually to widen their distribution reach and grow sales. And therefore, I would reckon that Eicher can potentially do better. And this is one stock which got damaged far more relative to the other two stocks in the recent past. If one were to really pick the stock, although I would say that two-wheeler as a space is good, so one can remain exposed to all the three companies, but you forced me to choose one, then I would say Eicher would be better at this juncture.